In today's episode, we're going to talk about how to trade in a business account in order to take advantage of the tax deductions that are available to small business owners. I would wager that 95% of traders out there are not doing the things that I'm going to share with you in today's episode, and as a result, are paying more in tax than is necessary, which essentially means you need to make more money each year to walk away with the same amount of net profit as a trader who is more tax efficient than you are. Now, we all want to talk about how to get better as traders in the form of finding the best stocks to trade, the best entries, the best exits. And it doesn't just have to be stocks. You could be trading crypto, you could be trading futures, whatever you're trading. But there's also something to be said for learning how to be more tax efficient. Because I could tell you, for instance, right now, because of one choice that I've made, I pay significantly less tax than most traders out there. And, well, it's to the tune of millions of dollars that I've saved. I'll share that with you during today's episode. Now, when most of us set up our first account as a trader, we do it in our personal name. And I was no different. This is what I did as well. And at the end of that first year, we get a 1099. And that tells us how much we made. Now, the problem with trading is that all trading income is considered short-term capital gains. In fact, any position that you hold for less than 12 months, less than a year, is a short-term capital gain. And short-term capital gains are taxed at the same rate as regular income. So if you made $100,000 working at a regular job, a W-2, or you made $100,000 as a trader, you would more or less pay the same amount of tax. You would pay a little bit more as a W-2 employee because when you get your W-2, they take out money for Social Security and they take out money for Medicare. When you're a 1099, you don't pay into either of those. So you do pay a little less tax as a 1099, but nonetheless, you're still paying a substantial amount. So let's just say, for the sake of keeping numbers round, that you made $100,000. Now, for most beginner traders, that would be a phenomenal first year of trading. When I got started, my goal was $200 a day. And in my first year of trading, I made about $30,000. So then this was more than a decade ago. It was a long time ago. But nonetheless, $30,000 for me was okay at that time. But again, cost of living has gone up, and many of you guys are going to try to be more aggressive than I was when I was getting started. So let's just say you make $100,000, approximately $400 a day. Well, if you made that as a 1099 and you live in a state like New York or California, you're going to pay upwards of, about $30,000 in tax. And this, for a lot of beginner traders, comes as a surprise. All of a sudden, they're like doing their tax or TurboTax or whatever it is, and they're like, whoa, I owe 30 grand? Because, as the year has been going on, we haven't been taking money out and contributing in to pay taxes the way you would as a W-2. The money has been growing and growing and growing and growing. Now, the worst thing that can happen to a trader is they make a ton of money between January 1st and December 31st. And then between the months of January, February, and March, they lose it. Because now you still have this tax right here, right? You've still got tax that you've got to pay into, and well, you don't have the money to pay it. So that's a terrible situation to be in. You want to avoid that as much as possible. But also, let's be real. Okay, $30,000 is how much you would pay without using any deductions whatsoever. So now let's contrast a 1099 versus an LLC or a corporation. Income produced in an LLC can be subject to a 15% self-employment tax if that's your primary source of income. And that's going to be a problem. So what that's going to ultimately do is the profit from the LLC is going to pass through to you. And then in addition to paying your regular short-term capital gains tax rate, you're also going to pay a 15% self-employment tax. Trading income is not considered earned income. So some people will argue that it's not subject to self-employment tax, which is very easy to argue when the trading profit's in your personal name. But when the trading profit's in an LLC, unless it's purely for the purposes of asset protection, it's going to be a little bit harder to justify, especially if you're taking all these deductions. So then ultimately what you're doing is you're taking deductions that are then just offsetting the 15% self-employment tax. What's even the point? So the other alternative is setting up a corporation, incorporating. So if you incorporate and you choose S status election, then all of the income gets passed through to your personal return and you are not subject to self-employment tax in an S Corp. S Corp shareholders who are also working for the company do have to take a salary, a wage, which we'll talk about in a minute. But that for me is totally tolerable and totally doable, and is preferable to the LLC's self-employment tax. So LLC or corporation, these are your two options. Ultimately, I will always choose to trade in a corporate account over an LLC when it comes to tax efficiency. So this is the reason. When it comes to tax efficiency, let me just show you what a lot of us are going to do as active traders. We're going to do the math. We're going to say, all right, well, I made $100,000, but look, let's get real. There's no way I made that without incurring some costs along the way. I mean, just look around. We've got 1, 2, 3, 4, 5 monitors. I've got 2 computers right here. And while this might be a little bit of a bigger setup than the average trader, it's still substantial. And hey, let's not forget, there's a desk right here. There's a little section of this house that is my home office. All right. Now, if you itemized all of these deductions as if you received a 1099, the problem is a lot of CPAs will say, that's going to be sending up a little bit of a flag for audit risk. But as a small business owner, especially if your business produces limited income, this is not going to be as much of an issue. So small business owners, I mean, look, this country was founded on small businesses. And so as a result, politicians have done a lot to advocate for small business owners such as ourselves. Now, although trading as a business may not be what they were really thinking of, they were probably thinking of, your mom and pop stores, your plumbers, your electricians, things like that. Nonetheless, we qualified because we were running a business as a trader. Okay, so let's say you made the $100,000, but let's figure you've got at least $5,000 in equipment. You got $5,000 in equipment, and now you've got your home office. So home office, and what are some of the expenses related to your home office? You've got either, rent, which some people will actually, factor in rent. And so what you do is you take what's the percentage square foot of your home office relative to your house. So if it's 10%, then what a lot of people will do is 10% of your rent, 10% of your mortgage, 10% of your property, property taxes, 10% of your insurance, 10% of all of these expenses right here. Boom, 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 boom. You're going to deduct through your S Corp. So what your S Corp might do is write you a check. So write you a check to reimburse you, and then you need to make sure you have copies of every one of these different invoices or statements so you can back up the deduction that you're taking, because you're saying this is a home office, this is a business expense, which is a valid business expense, but you've got to make sure you've got it all dialed in. You've got to be very detailed about it. If you're willing to be detailed, if you don't mind maintaining a QuickBooks file, which is super simple, I mean, it's really not hard stuff, then keep that QuickBooks file, keep a folder on your computer for the year and your statements, which is your receipt. And then for every line item, just make sure you've got your backup. This is the proof that this was the expense. So now all of a sudden, you're deducting 10% of your rent, your property taxes, your insurance, all this stuff, your internet, the heat, the cooling, energy bills, et cetera, et cetera. Now this can be a significant deduction. All right. So let's say it's $1,000 a month. All right. That's still $12,000. So now you've got your $5,000, you've got your $12,000. This was money you had already spent. You were spending this essentially as it were, but now because you've got a home office, because this is your business, you now have the ability to deduct it, and that reduces your income. So now all of a sudden, instead of having $100,000 of taxable income, you've reduced it by $17,000. So now you're at $83,000 of taxable income. All right. So hey, that's a step in the right direction, but there's certainly more that you can do than just this. I mean, this is keeping it fairly simple. Some traders are going to take it a step further. And let's say, for instance, what are some of the other expenses you incur? Let's say you're spending $100 a month, $200 a month on streaming news services, on trading platforms. You're spending money on continuing education, right? You're spending money on chat room memberships, things like that. All right, you've got to start deducting these. You should be deducting them. You should be at least accounting for all of this, because these are expenses that you're incurring in order to generate this profit. This profit does not ever come without expenses. But what a lot of beginner traders do is they just don't keep track of it. And then at the end of the year, they're like, oh my gosh, I owe $30,000. It's like, well, hold up, add up all these expenses. You're spending, $1,000 a month on the home office. You're spending $5,000 on equipment to get started. You're spending over the course of the year, let's just say $8,000 here. So you've got $25,000 in expenses. All right. So now your taxable income is $75,000. Now let's just say for a second that you really don't need $75,000 to make a good living. Well, now this presents a very interesting situation because you made $75,000, but you don't want to necessarily pay tax on the full $75,000. Let's say you really only needed $1,000 a week to cover your cost of living. That's $50,000 a year, which means you've got an extra $25,000 here of taxable income. What are you going to do about that? Well, this is what a lot of people will do in an S Corp. So in an S Corp, one of the rules for an S Corp is that you have to take a salary. You have to take what's called a reasonable salary. Now, reasonable is obviously a term that can be argued one way or the other. You could reasonably maybe say you should have a very high salary. You could reasonably say your salary could be a little bit lower. So let's just say, for the sake of argument right here, that you're going to take a salary of $50,000 a year. Okay, so you're taking a $50,000 annual salary. Now, let's hold up. So minus $50,000 here is your salary. Your company deducts that, right? And then you, of course, receive that on your personal return as your W-2 salary. So now you are essentially a W-2. But the company at the end of the year still has $25,000 sitting here in profit. Now, $25,000 can be distributed to you as a shareholder, and you get a K-1. That's a distribution of corporate profits. That is not going to be subject to the same taxes as W-2 income. All right, so that's one thing you could do. You could take a distribution. That's going to save you a little bit, but you're going to still pay income tax on it. So what is a better way to do this is to set up a solo 401k. You set up a solo 401k and you do an employer match. You can contribute up to $23,000 a year into a 401k. And if you do a profit sharing match, you can have total contributions of $69,000 a year. $69,000 a year you can be putting away tax-free. You're putting it away and it's coming off your total taxable gain. So now let's just say, for the sake of argument, instead of making $100,000 a year, let's just say you fully maximized on your 401k. Boom, $69,000. You now have $31,000 of taxable income. Now you write off some of the home office deductions. You have the deductions for your equipment and things like that. Now your tax bill is going even lower. Naturally, you need money to pay your bills. And so the money for paying your bills is what's ultimately going to be the money that you're going to have to pay tax on, because there's not really a good way around that when it comes to trading profits. There are fancy things that people do with real estate, where they'll buy something and then they'll refinance it. They'll take the money out and you don't get a tax event on that. But that's complicated. You need a lot of money to get started in that business, and that's not what you guys are here for. You guys are mostly focusing on trading. So when it comes to trading, you pay yourself the salary, and since you're the only employee, this is super easy to set up. So you pay yourself a salary, and then you do a 401k. So you set up a 401k, and then you can do 50% from you. So $12,000 from you, $12,000 from the company. You give yourself a bigger salary to accommodate the 401k contributions, and then that nets you down to zero. And what you've effectively done is you're now paying tax on $50,000 of salary instead of $100,000 of salary, and you're putting aside $25,000, which is tax-free, right? That's nice. That's really nice. And these are things that anyone can do, but most people aren't doing them. Now, I'll tell you, in case you didn't know, I'm not a CPA. I'm a trader, but I've been doing this for a long time, so I've gotten a good sense of what different people do, both my students at Warrior Trading, but also myself. So one of the things that I did when I first got started, when I was first trading, I set up an account in my personal name. And then I set up an account in a business account, and it was an S Corp. I did that for many years as an S Corp, and it made a lot of sense. I did all of these things. I took the deductions. I had an accountant that reviewed it, but I had my equipment, I had my expenses, and that was able to offset my total gains. So I wasn't making a lot of money in those early years, but those were the times where things were tight. right? Things were really tight for me at that time. And so every little bit made a difference. And for me, I felt like the difference between success and failure, it was the difference between $100 and $200 a day, consistently making $50,000 a year or consistently kind of struggling. And so if I was able to reduce my taxes a little bit by making sure I was deducting equipment that I had already paid for, that I had bought, these computers, the monitors, the internet service, right? You're leaving money on the table if you're not taking advantage of any of this stuff. So what I would say is that a good accountant is worth their weight in gold. So let's say a good accountant's 180 pounds. 180 pounds, you do the math, they're worth a lot of money in gold. This is something that you should really consider. Spend an hour, 2 hours getting a consultation from a good CPA and having them lay out for you the options. Trading in an LLC, trading in an S Corp. Again, I'm always going to choose an S Corp. I think it's the better way to go, but you could choose whatever's best for you. Choose the LLC, choose the S Corp. Either way it is okay, I suppose. I prefer the S Corp. With an S Corp, you do have to take a salary. With an LLC, the problem with an LLC is that it is just going to pass through straight to you. And you can do S status election with an LLC, but you might as well just do an S Corp. It just, to me, makes more sense to do an S Corp. And then you can do your 401k. You've got your solo 401k. You could do your contributions there. And this, to me, just makes the most sense. So when it comes to setting up an S Corp, one thing that I made a little bit of a mistake on when I first got started was I set mine up in Vermont because I lived in Vermont. I was like, well, this makes sense. What I didn't realize is that there are states that have more favorable laws for corporations. Delaware, Nevada, right? This probably isn't a surprise now that I say it, but a lot of companies you'll see they're incorporated in Nevada, incorporated in Delaware. These are states that have really friendly laws for corporations specifically. And they have good asset protection for corporations. So that way you're protecting the assets that are inside the company, which ultimately is your trading account, from any possible liability that might come if, you run over someone, God forbid, but let's just say you run over someone's foot. They're standing too close to you in the parking lot, you crunch their foot. All right, and let's say they're a professional soccer player. So now they're going to sue you for $1 million. Well, if your trading account is in your personal name, you've got liability there. If your trading account is in an LLC or it's in an S Corp, it's protected. So, it's like good housekeeping. It's a good idea to do it. You'll probably never need it. You'll probably never be in a situation where that would happen. But, set it up. It's easy enough to do, and it has sort of multiple benefits. Now, the ultimate way to save taxes when it comes to trading is to start trading just in your retirement account. So now you've got this solo 401k, for instance, or what I like to do is I like to set up a Roth IRA. So what you can do is you take a little bit of profit from trading, you take $6,000, let's just say, and you contribute it into a Roth IRA. You do that, and now you can start trading in this account, and the income that's produced in the Roth IRA is tax-free, and the distributions, when you take them, are totally tax-free. The only problem is you can't take a distribution until you're 59 and a half years old. So you have to wait a little while, well, depending on how old you are, of course. But once you start taking those distributions, the distributions are totally tax-free. So if you're starting to trade and you're in your 40s, you're in your 50s, this would be something where, okay, I have no income tax now, and, in the not too distant future, I could be taking that profit out totally tax-free. So with a Roth IRA, the maximum contribution limit, I think right now, is moved up to $7,000. But in any case, what I did was I contributed $6,000, which was the max contribution at that time. And I did it 3 years in a row. $6,000 year one, $6,000 year two, $6,000 year three. I actually did a traditional IRA and then converted it. A lot of people do this. Anyway, so I contributed $18,000. And then from there, I grew the account to over $6 million. And I did that totally tax-free. If I had made that same $6 million in a taxable account, I would have paid nearly $3 million in income tax. That's real. So that's how much I saved by using a Roth IRA. Now, as for me, I was making so much more money than I needed to cover my cost of living. And so it was like, how do I defer having to pay tax? Because making $6 million or $5 million in 1 year, which I did in 2020, I just didn't need that much money for my cost of living, but it's not like I wanted to stop making money. The market was hot. So I thought, I'm just going to focus on trading in my Roth IRA. I can't touch the money right now, but I can just grow it. And at that time, I was trading in two accounts. I had a business account and I had my Roth IRA. The business account was the account that I used to make enough money to cover my cost of living. And then once I exceeded and it sort of met that number, then everything after that, tax-free. So I was constantly thinking about this because I wanted to be as tax efficient as possible, especially when I got to the point of making millions of dollars in 1 year. As a beginner trader, making $20,000, $30,000, $50,000, $100,000 is the amount that you're saving by taking some of these steps as big as someone who's making millions? No, it's certainly not, but I think it's a good idea to lay the foundation. And for most traders, it's also like, why not? Why not? Because you're just going to be more efficient. Why not take these deductions? Why not set up the accounts the right way from the beginning? On the other hand, if you have losses, if the S Corp or the LLC has a loss, then you're able to deduct the business loss against income that you've got somewhere else. So, I just think it makes sense. And I've had so many traders over the years who have come to me and said, Ross, should I trade in a corporation? Should I trade in an LLC or my personal name and this and that? And what I often have said is, first things first, get your trading dialed in a simulator. So there's no taxes on simulated trading profits, obviously. So first get good in a simulator. And then once you've gotten good in a simulator and you're getting ready to flip the switch, if you want to just set up a regular account in your personal name for your first year, then do that. Right now, you're still kind of on the up ramp getting dialed in. Prove that your strategy carries over from sim to real money. And if it does, and you start scaling up, then it's time to take that next leap. And again, some people are going to go ahead and do it immediately and start deducting all the expenses, even when they're trading at a loss, because they're thinking, well, I'll deduct that against maybe, other income that I have. And sometimes the first couple of years of a business do lose money, but that is offset against my other income. So it makes sense. And that's fine too. You have to do what's best for you. And so as always, I would encourage you to consult with a CPA or a tax attorney and have them give you the advice of, what makes the most sense for your specific situation, for the state you live in, of course, the country you live in, and everything else. If you enjoyed this episode, I hope you hit that thumbs up and I hope you subscribe to the channel, and we'll see you for the next episode real soon.